Hello, hello, hello. Craig Steele. Craig Steele with RAM, Real Estate and Mortgage, YouTube channel and podcast. My goal is always to deliver insight and education and more on mortgages and real estate. So today I wanted to talk with you a little bit about first-time homebuyers. First-time homebuyers, I love them. They're great people. Those that don't own a house are not first-time homebuyers. But technically, the term for a first-time homebuyer is somebody in the last 3 years that hasn't owned a house. But we're specifically going to talk to maybe first-time homebuyers that haven't ever bought a house and kind of unveil some of the secrecy or some of the myths and misconceptions about first-time homebuyers. Let's see here. And navigating the home process doesn't have to be hard. And there's all kinds of myths. So first, let's break this down. First-time home buyers, do you need 20% down for a mortgage? No, you don't. 20% down is key if you want to avoid mortgage insurance. So let's just go into that real quick. Mortgage insurance is an insurance that insures against default. It does nothing for the home buyer. It only does something for the bank. So banks typically, if they are, doing a loan, they want to be insured that in case of default, the bank gets paid back. So that's what mortgage insurance is. And anytime you're over about an 80%, unless you're in California, unless you're about over an 80% loan to value, you have mortgage insurance. There are some programs in California, because loan amounts are larger, that they'll do mortgage insurance on more than 90%. Mortgage insurance is something, like I said, it doesn't do anything for the home buyer, but it does actually insure against default for banks itself. Let's delete this myth also about first-time homebuyers. Are there special programs because you've never bought a house before that you can actually get as a first-time homebuyer? Well, sure. There are some benefits sometimes. Sometimes individual cities or individual places will do a specific grant. In several different cities, there might be a specific grant where they're giving you X dollars towards closing costs or something, or your down payment. Typically, those programs are funded by the government, by your individual state, and they usually run out pretty quick. I was going to say 9 times out of 10, but I'm not going to say that. There are those programs that are available, typically in a market where they're trying to incent buyers to actually buy houses. And usually every year, and it's December now, so usually in January they're replenished with money, and there's typically some of those grants that are available. I live in Utah. Utah does have some housing grants. But we do have to check into each individual scenario to make sure that they qualify. And there's always strings attached with a first-time home buyer with grants and whatnot. And let's not make a mistake. Sometimes a grant is a forgivable deal, but a lot of times there are programs out there that aren't forgivable. Yes, they help you with your down payment, but the minute you want to refinance or sell your house, that money has to be repaid back to the state. And that money continues to stay in the system and help other clients as well. So be careful with thinking that, there's just something free out there for nothing, because that's never the case. Also, let's just talk about those specific grants. A lot of times those specific grants come with a price tag that's much higher than just a standard regular loan. So for example, if a FHA loan is a 3.5% down program, and you have that money down, great. Maybe you'll, check with the rate, check with the loan officer, check with the rate. But because a rate itself is much more important than just getting your down payment, because you have to pay that back over time, or you have to pay back at some point in time. Just case in point, sometimes we'll wrap a first mortgage with a second mortgage, and the second mortgage is the down payment that is the down payment assistance for a first-time homebuyer. That down payment assistance typically is at a higher rate, sometimes 1%, sometimes 2% higher than your standard rate. And because lenders, and I'm just being truthful with this, don't make a ton of money on those type of programs, sometimes the interest rate on those isn't necessarily the best interest rate. Now, if you're working with state housing departments, state housing authorities, typically those rates are the same no matter which lender you work with. In Utah, Utah Housing. Utah Housing, you can go on their program and you can find out what their rates are. There's typically several different programs, First Home or Home Again or something like that. You're able to get into a house with virtually no money down other than your earnest money. And yes, they are good programs. But the myth that there's something vastly special and different, no. And I would dare wager when you break it down dollar for dollar, it's actually a program that costs you more money in the long run than it does in the short run. So if you don't have money for down payment, sure, let's use those programs. If you do have money for down payment, I would suggest not using them because you're going to get a better deal, a lower payment, and an overall better mortgage. Let's talk about FHA versus conventional versus VA. So if you are a veteran, VA loans are incredible. I think they're the best loan that is out there. A VA loan is truly a 0% down loan program. You can put money down, but it's not necessary. They'll finance 100% of the loan amount itself. And VA rates are typically pretty decent. They're not quite as good as FHA, but they're slightly better than a conventional loan. Let's talk about FHA. FHA, Federal Housing Administration. Okay, that's what that stands for. It's not First Time Homebuyers Association. It's Federal Housing Administration. And an FHA loan is a great loan. It's typically a 3.5% down, but there's a caveat with that. And typically an FHA loan rate is slightly better than a conventional rate. But here's the caveat with that. On an FHA loan, you have a funding fee, so to speak. It's called upfront mortgage insurance premium. You're going to be charged 1.75% of your loan amount as an insurance. Once again, it's that mortgage insurance that insures against default. It insures the banks against default. You're charged a 1.75% fee up front that is financed into your loan. And then on a monthly basis, you do have a factor of 0.50 that is charged on an annual basis divided by 12 for insurance. So you're paying 1.75% up front, financed, as well as 0.5 on a monthly basis that you're actually going to be included in your mortgage payments. Yes, it's great, and it's typically good for first-time homebuyers because you can go to a much higher back-end debt ratio. And speaking of debt ratios, let's just define what that is. You've got a debt ratio and you've got a back-end debt ratio. Your front-end debt ratio is just the housing debt ratio itself. The back-end debt ratio is your housing plus all of your other debts combined. And that back-end debt ratio cannot exceed a 56.9% debt ratio. And it's all based on your gross income, not your net income. So a lot of times I can get a client into a FHA loan better than I can get into a conventional loan just because their debt ratio is a little bit higher. And Lord knows that with first-time homebuyers out there right now and the prices of houses, sometimes it is easier to go with an FHA loan. No big deal. You can actually refinance your FHA loan into a conventional loan somewhere later down the line when maybe the conventional loan interest rates catch up to the FHA loan. Or when you hit an 80%, I would never refinance into an FHA. I would always refinance into a conventional loan because you drop the mortgage insurance. And that mortgage insurance is an insurance just against default that does nothing for you. So when you hit that 80% loan to value, yes, I would refinance into a conventional loan. And sometimes it makes sense to even refinance before that. VA loans, sorry about that. There is a VA funding fee every time you use a VA loan as well. I believe the first time you use a VA loan is about a 2.45%, and the second time, called subsequent usage of your VA entitlement, is about a 3.2%. And so it can be very expensive. They don't have monthly mortgage insurance, but there is a VA funding fee financed on top of your mortgage up front. But still, 100%, I think is the best loan out there. There's also another loan out there called USDA. USDA typically is 100% financing, and there is a very small amount of mortgage insurance that is actually collected on a monthly basis with that. Typically, these areas are more rural. They're more out of the major metros. So, for example, in Salt Lake County, you're probably not going to run into that. Perhaps in Utah County, way west, in some of the areas, Box Elder County, some of the other areas, yes, you can run into these situations, but check with your loan officer because your loan officer will know those areas and they'll be able to tell you what it is. As far as first-time homebuyers, what is needed? I mean, hey, I want to buy a home. Where do I go? Where do I start? Well, first off, call me. Okay, call me. I'm a licensed loan originator and I can help you get pre-qualified. The biggest thing that you need to know is you need to find a basis of where you're at, what your debt ratio is, what your credit scores are, how much you can afford. That's the most important piece. So call me. I'll walk you through it. There's no obligation. I'll walk you through it. Let's check it out and let's tell you some good advice on what you can expect. But here are the three things that you're basically going to need. First, you're going to need pay stubs. You're going to have a bona fide qualified job that you're working. And we're going to get into income differences here in a minute. Second, we need to have your bank statements. Okay. Why do we need your bank statements? Well, basically, we need to verify that you have money in your bank and you're able to come to the table with that, because there's always closing costs and other things, your appraisal, the title costs, the inspection fees, all those things that are needed when you buy a home. So we basically verify that 3.5% down in your checking account or your savings account or your 401k account, which, by the way, is a great way to actually get your down payment, borrow it from your 401k. So we look at your bank statements. We look at your pay stubs, 2 consecutive pay stubs. If you only get paid once a month, great. I need 2 months bank statements. If you get paid twice a month, great. I need 1 month's pay stubs, and they're sequentially in order. Okay. Last thing we need is basically 2 years taxes. So 2 years taxes. The Form 1040 is the IRS form for your standard personal tax returns. A W-2 is where that income is reported and you file that with your taxes. So for FHA, typically you're going to need those 2 years tax returns and your W-2s. Now let's move back into conventional a little bit, because on conventional, sometimes I don't need 2 years taxes. Sometimes I can base it off of 1 year's taxes with your W-2. You're a W-2 employee, you get a salary or you're hourly, and I can just use 1 year's taxes for your income validation. FHA is always going to require 2 years. So conventional sometimes is easier as far as qualifying because you don't have 2 years taxes. But it's definitely better to have your 2 years taxes if necessary. That brings me to another point. Do you need 2 years taxes in order to qualify for a loan? Well, standard is 2, 2, and 2. 2 months bank statements, 2 pay stubs, and 2 years taxes. But there are programs out there that allow us to help you figure out a way to get into a home without those 2 years taxes. Let's delve into 1099 or self-employed. Typically, if you're 1099, which means you're a contractor for somebody else, work for another company, you are going to need 2 years filed taxes in order to do that. Although, once again, reach out to me because I do have a couple of programs that aren't necessarily as stringent in that requirement, and we can go off of your 1099. Sometimes if you haven't filed your taxes, I can go off of 2 years 1099s instead of the actual filed taxes, and that can be a good thing. But just remember that sometimes there is more required as down payment if that is the case. Job stability. Job stability is one of the biggest things with FHA. They want to see that you are actively employed and that it's not something that you change every other month. For example, if you have 3 jobs or more in any given year, FHA is going to over scrutinize that. They don't necessarily like that. They think you're a job hopper. So if you are going to change jobs, but you also want to buy a house, wait on the job change until after we get the home closed. And by the way, never change jobs during the midstream. I just had a situation where I had a client that were fully underwritten. Basically, we were approved, ready to go, and they changed jobs a week before they were supposed to close. Which, of course, then we have to revalidate everything, verify the new job, get a verification from the old job, verification from the new job, start time, when they're going to get paid. I mean, it can create a mess. So never do anything major during the time when you're buying a house, like changing jobs or buying a new car or something like that. It can create a mess. And of course, we love to see good payment history. If you got a credit card or a car loan or something like that, make those payments on time. Even if you have rent that you've been paying, you can actually have that rent reported on your credit report as good credit history, which is not necessarily a bad thing. So Let's also talk a little bit just about down payment. So FHA, typically on an FHA loan, you're able to get away with a 3.5% down payment. So, it's real easy to calculate. You're 300,000, 3.5% down, 400,000, 3.5% down. Those are your typical FHA numbers. Remember, a VA is no down and USDA is no down. Now, on a conventional loan, there are a couple of different programs. Your standard typical conventional loan is 5% down. Okay, it's a little bit more than FHA. But there's also a program through Fannie and Freddie, which are conventional loans, which are conventional players in the market, where you can do as little as 3% down. The only thing I'll caution you with on that is on a 3% down, you have to be below a median income threshold. And once again, talk to the loan officer. They can look up what the median threshold is for income because sometimes there's income limitations on that 3% down program through Fannie or Freddie. Typically on an FHA, there is not an income restriction with the 3.5% down. That's why I like to put people into FHA loans, and it's just a good loan. The 3% conventional loan is not a horrible loan either. It's a good loan. Albeit, if your credit scores are a little bit less than desirable, and let's just say if they're below a 680, you're going to pay more in mortgage insurance typically than you would on an FHA loan, because an FHA loan is a set 0.50 on a monthly basis for your mortgage insurance, which is that insurance that insures against default. On a conventional loan, your mortgage insurance can be vastly different. If you have excellent credit and you've got 5% down, your mortgage insurance is actually can be maybe a little bit better than FHA. But if your credit scores are suffering a little bit, maybe they're in the mid sixes or something like that, even down to a 620, your mortgage insurance is going to be probably not the most expensive, but a very costly portion of your mortgage itself, because you got your taxes, your homeowner's insurance, your mortgage insurance, and your principal and interest. And that mortgage insurance can be very stout. So if that's what it takes to get a house, great, get into it. But be sure that you're working with me, working with your loan officer. Make sure you're keeping track of that, so that at some point when your credit score goes up, you can actually refinance and lower that mortgage insurance drastically. And I love to call clients that I've dealt with in the past that might have had a little bit lower credit score, and all of a sudden their credit score is in the 720, 740 range, and we can refinance and get that mortgage insurance dropped. I've seen it drop from a 562 monthly mortgage insurance payment down to about a $68 a month mortgage insurance payment. So those are always things that you need to consider. It's not just a one and done. And any lender that you deal with that just wants to be a one and done and never talk to you again, I would avoid like the plague. You need to have somebody that's going to walk the walk, talk the talk, and be instrumental and educational with you long term, because these are the biggest loans you'll probably ever get in your life. You might as well have somebody that's willing and able to walk down that path with you and continue to be a mentor and an educator for you in the whole process. I've had hundreds of clients come back to me and maybe buy a second home or a third home, or even an investment property, or just continue to refinance the current home that they're in based on the market and what their needs were, whether it was college, whether it was kids, whether it was, they needed to do some cash out, or they needed to come to me for a home equity line of credit. It's always good to have somebody that you trust to actually continue doing your loan. And I've been in the business for 32 years, doing hundreds upon hundreds of loans for hundreds upon hundreds of clients. Honestly, if you can dream it, I can figure out a way to get you into it. Okay? And that's kind of the thing that I want to say. Let's see here. What else? Housing payment. Let's just talk about that real quick, because your housing payment, I kind of touched on this a little bit, consists of 4 different things. Your housing payment is your principal and interest, which is what your mortgage is calculated on. Homeowner's insurance, that is just in case your home decides to burn down, they'll replace it. Okay, that is important. Can't do a loan typically without that unless you're doing it on your own. Property tax. Property taxes need to be paid on an annual basis, or the state puts a lien on your house for taxes. So principal and interest, homeowner's insurance, property taxes. And if you are over 80% loan to value, typically you do have that mortgage insurance that is a part of your mortgage payment. So all of those things make up the mortgage payment. You might be renting right now thinking, well, gosh, it's kind of easy. I just, I rent, I just pay one payment and I don't have to worry about property taxes, homeowners insurance, or any of that other stuff. Well, yes and no. Typically, if you're renting, I would recommend that you have renter's insurance. So there you go. It's kind of like the homeowner's insurance. Also, that rent payment that you're paying, yeah, it might not include property taxes or homeowner's insurance, but you're also not gaining any value in your investment that you've actually got into because it's a rental. It's not actually, something that you own. Um, and guys, I post this on RAM Real Estate and Mortgage. I want to be as educational as possible so that people can understand what the process is with mortgages. I am also a licensed real estate agent and more than willing to show anybody a house and get them pre-approved and show them a house. The American dream isn't just a dream, it should be reality. But once again, if you can dream about it, I can figure out a way to get you into it. It might not be today, it might not be it might not be tomorrow, but we will get you in a house and we will get you into the right program. Once again, I'm Craig with this is Craig with RAM Real Estate and Mortgage. I'm glad you're here. Glad I could do something for you, and hopefully this is educational. If this is educational, please subscribe, share it with your friends, share it with your mom and dad, your brother and your sister. Sharing is caring. Thank you.